The stock market is down again, and I have no idea if this is just a dip, a correction, a bear market, or something even worse. But no matter what kind of down market we're in for, let's make sure we understand what all these terms mean. Today we're defining the 10 most important terms when the stock market turns red, ranked from no big deal to full-blown economic disaster. So you know what these terms mean when they get thrown around as they have been lately, and what it might mean for your money. And at the end of the video, we'll take a look at the current down move in the market and figure out which of these terms apply. Are we in a dip, a correction, or are we already in a bear market? Let's start with those no big deal terms. Terms that refer to normal market fluctuations. These are small and short-term declines that happen all the time and aren't a reason to panic. First, we have the dip. A dip is a minor, quick decline under 10%. Most dips recover quickly, making them great buying opportunities. An example of a dip is September 2021, when the S&P 500 dipped about 5% due to inflation fears. And then the market recovered as it always does. In this example, the recovery time was about 1 month for the market to return to its previous high. Next, we have a correction. A correction is a 10 to 20% decline from recent highs. So you can't technically call it a correction until it's gone down at least 10%. Corrections are common and happen every few years. A recent example is in early 2022, when the S&P 500 dropped 19% as the Fed raised interest rates. The recovery time for this example was about 6 months. Next, we have a sell-off. A sell-off is a panic-driven decline in stocks that creates sudden selling pressure. Sell-offs are often emotional reactions to news and not long-term trends. An example is the COVID flash crash back in March 2020, when we saw a 30% drop in a matter of weeks. The recovery time for this example, 5 months. So those are a few terms you'll hear to describe normal market fluctuations, but what about more serious market declines? These indicate bigger problems, but not necessarily full-scale economic disasters. We'll save that for the end. Surely you've heard of a bear market. A bear market has a very specific definition. It's a 20% or greater decline from stock market highs, and if we experience a bear market, we may be in store for prolonged pain. But not necessarily. Some bear markets recover fast, while others take years. An example of the bear market is, of course, the 2008 bear market that lasted 1.5 years and saw a 50% drop. This was also part of the Great Recession, and yeah, it was a rough time. The recovery time in this situation, over 5 years. Wow. But since that time, we've had an incredible 15-year bull run. The next term is a crash. Nobody wants a crash because that is a sudden, extreme drop, a 10% or more decline in a single day. Crashes are rare, but they can absolutely be devastating. The most famous example of a stock market crash was Black Monday, 1987, when the market saw a 22% one-day crash. The recovery time for this one, 2 years. The next term you might hear is a bubble burst. This is where you have overinflated prices that collapse very quickly. Bubbles take years to recover from because they involve extreme speculation. The most famous modern example of this is the dot-com bubble burst in 2000, which wiped out 78% of the Nasdaq's value. This is where people went wild for all kinds of new dot-com companies, and they were just bidding these things up, bidding up these names, speculating wildly, and there wasn't much behind it to support these very high valuations. And yeah, that bubble burst. Recovery time? Nearly 15 years. Yikes. Next, let's talk about the real disasters, economic crises. We definitely don't want to see any of these because these go beyond the stock market and impact jobs, businesses, and everyday life. First, we have a liquidity crunch. This is where banks stop lending and credit freezes up. This can turn a run-of-the-mill downturn into a full-blown financial crisis. An example of this, 2008, when banks cut lending, worsening the stock market collapse. The recovery time from this was over 5 years. Next, we have a recession. And a recession has a very specific definition. It's 2 quarters of negative GDP growth, which results in job losses. Recessions happen periodically and thankfully don't always lead to depressions. An example of a recession was the COVID-19 recession in 2020, when we saw GDP collapse 30% in the second quarter when everything shut down suddenly. Amazingly, the recovery time from this recession was less than a year. Next, we have a financial crisis. This is where you have widespread economic collapse with major government intervention required. A financial crisis threatens the entire banking system. As an example, let's go back to 2008. The financial crisis in 2008 led to massive bailouts and global economic turmoil, and the recovery time was over 5 years. And finally, we have to talk about the worst case scenario. This is the nightmare scenario, a full-blown, long-term economic collapse. You may know it as a depression. Not the psychological kind, but the economic kind. A depression is a severe, long-lasting economic collapse with 25% or greater unemployment. A depression is a lot like a recession, but much, much worse. As an example, we have to look at the Great Depression. The Great Depression from 1929 to 1939 saw the stock market drop nearly 90%. Imagine that. Unemployment hit 25%, and global economies collapsed. This was a long period indeed, and the recovery time was over 10 years. And that brings us to our current market downturn. From our peak in January to today, when I record this on March 12th, the market is down 7.7%, which puts it squarely in the category of a market dip. That's right, we're not even in correction territory quite yet because we haven't gone down 10%. So we can call this a dip. Maybe we can buy the dip. Time will tell whether this turns out to be only a dip, a quick decline that recovers, or if this turns into a correction, a bear market, or something worse. We can't predict the future. We don't know where things go from here, but we do know that so far this is considered a dip. So I hope this was helpful to define these terms, and the next time you see these terms being thrown around in headlines, in news reports, or even YouTube videos, you'll have a better idea of what they actually mean. That's what I have for you in this video. I would appreciate it if you could give the video a like, feel free to leave a comment, and definitely check out this video next.